Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined by my good friend, Jeff Santoro, the voice of the people. Jeff, I just have one question for you.
Yes, what is it?
How bad is my hair right now?
Compared to what it used to look like, it's actually pretty great.
So mean, yet true. Really, is it okay?
I mean, just don't turn your head. If you're facing straight on, and this is great for audio, by the way. If you're facing straight on, it looks fine. When you turn your head, you look like you just woke up from a nap.
Super windy day today, and I decided to cut the lawn in the back because you were going to be late, and I know I was going to have some extra time. Got that done, and now it's time for podcast. What's our show about today, Jeff?
I thought it'd be fun, and you agreed, to talk about what we do in between earnings deluges, because this might be a little bit unique to us, Jason, because we have you a full-time job and me a part-time job where we have to talk about stocks in the market. So we're sort of forced to pay attention, but there are weeks during earnings season where it is absolutely overwhelming. It is like drinking from the fire hose in terms of trying to keep up, not just with the stocks we own, but then stocks we're interested in or stocks we have to write or talk about. And I would imagine for people listening who own individual stocks and just manage their own portfolio, but like want to know how their companies are doing and have that quarterly update, it probably feels the same way in certain weeks. And then you get to now where it's just a trickle over maybe one or two a week, maybe none. And you forget how much time you kind of get between the end of the deluge and when it starts again. Like we won't get the next cycle that kicks up until like mid-January. Like mid-January is when the banks will start reporting again, and then we'll do it all over into February. So we got this time now, Jason, where it's slower, you can process, you can think. So we're going to talk about what you and I do in between the earnings seasons and maybe some mindset things, how to spend that time, where to focus, what not to do when it's crazy during earnings season and all that stuff.
Yeah, this is very much like a back to basics, getting into like the toolbox and just the basic skill set of things that work if you're an individual investor, not a professional, not a money manager, not a trader, right? Just, you're DIYing a portfolio and you're trying to optimize your returns, reduce your risk of loss, and also make the most of the time that you have, because I think that's a really big part of this conversation, Jeff, one that you certainly know very well because it's far more for you, a thing you do in your spare time. And that's one of the things I've always tried to maintain some semblance of a balance, is because the best cheat code in the world is get a job that you love that's tied to investing, where you get paid to do research, and it's pretty fantastic. So that's a big one. So where do we want to start?
What got me thinking about this was actually one thing. There are very few things you've said to me that I actually listened to. But one thing that you said to me a long time ago that I don't think you meant for it to be something that stuck with me, but it did. It was when I was a much newer investor. I don't know, it might have been even before we started the podcast, but we were texting or chatting about something. And I asked you some question about like earnings reports or like, did you see this or did you read that? And you said something like, no, I won't look at any of these until like a month from now.
Yeah.
And I remember being like, that's interesting. Here's someone who's been doing this a lot longer than me, who does not feel compelled to know how X company did today, even though that's when they reported. And I think that lived as a seed inside my brain and sort of has germinated over time, because I find myself now pretty much in that same place, unless I need to look again to talk about it or write about it or do something, a podcast about it, or if some big news popped and I just kind of want to see what happened. I might go days or weeks without doing anything other than quickly updating my spreadsheet, because that takes me just a few minutes of dropping numbers in. Like to this point, I own 37 stocks, I think, and I probably keep up with another 10 or 15 like pretty regularly. I think I've read like 3 10Qs and maybe listened to 3 or 4 earnings calls from this past cycle. So I'm like very far behind, but I'm not worried about it because I have 2 months from now until this thing kind of kicks back up again. And I will be in a much better place to digest what I hear and read when I'm not thinking about, oh, the stock dropped 20% yesterday or popped 15% yesterday. In fact, right now, I don't even remember what most of the companies I own did after earning, right? Which I think is a good thing. Like that,
It's fantastic.
I think it's a good thing.
I think that is fantastic. And yeah, we'll talk a little bit more about like that and like how I went through the transition to that, because I think there's some interesting context about it. If you want to talk a little bit more about, since it's a little fresher for you, late 2019, early 2020 is kind of when you really first like dove headfirst into picking individual stocks and taking some control over making those direct directed decisions about where your money was being invested. Let's just talk through your journey. I think a lot of people who listen to the show have heard it before, but I think it's always worth revisiting because it's probably going to ring really familiar to a lot of people.
I'm going to start in a slightly different place because I think this is relevant to the conversation. I don't know if you've had this realization yourself along the way, but there are certain things I used to do when I was like a brand new investor that I clearly now know were ignorant, misguided, wrong. There's some things I used to do that I got away from that I wish I still held on to. And here's an example. One of the things that I always did when I was a brand new baby investor is if a stock I owned dropped big after earnings, I would immediately go to try to figure out why the market was wrong. And I would try to defend my company to anyone who would listen to me. So I would text you or I'd talk to someone else that I knew at the Fool and be like, I think this was an overreaction. This is what I thought was good. This is what I thought was good. And I don't have data to back up how often I was right about those things. But I feel like I was right more than wrong because sometimes there are just overreactions. Now, I didn't necessarily trade on those feelings. I just sort of like wanted to be validated and have someone agree with me. But I kind of wish I still did that in a way. Like I almost wish I had that lack of experience that drove me to just be the contrarian and fight against what the market did. Because I think in a lot of cases, that's actually, the truth is in there. But not entirely, right? If something drops 20%, there is an actual reason. It's not entirely sentiment.
That's exactly right. And I think that's important too to talk about is that I think, there's kernels of truth in what you're saying, but I do think broadly the market, and I want to try to contextualize, like really put this in good context. I think broadly the market reacts appropriately to the information that investors who are moving the market are reacting to. I don't necessarily fully believe in like the idea of the rational markets theory that every asset is priced appropriately at any given point in time. I think that's total BS. We have reams of evidence to prove that like the rational market theory doesn't make sense. But what we do know is that the market is extremely good at taking the information that is provided and then acting on it very quickly. Whether or not that information is accurate or relevant is a different thing entirely, right? We've seen plenty of short reports over stocks over the past 20 years that have moved the market substantially in the short term. Now, what we do find out is that over the long term, if there was no meaningful, true problem with the business, then the short report was irrelevant,
right?
And potentially created an opportunity for people with money to put to work to improve their returns. But things like earnings, right? That's material. That's real stuff that the market can guide us down the path to. Now, the reactions may be extreme for one reason or another. Things like shorting stocks, super hot markets where investors are putting extra money in or using margin to buy stocks that have a lot of exposure to options that are volatile already. Those can swing the stocks in outsized ways ups and down. But directionally, I think largely the market does get it right. It is, especially coming through earnings season. And it's so important to think about what our goals are and what are the things that we have in our toolbox that can help us reach our goals, that are things that can help us be better and do better. Or even thinking about like, what are the things that I have to play this game? What is the game that I'm playing? Not what is the game that Wall Street is playing.
And to that point, even when there is a drop, when a stock reports during earnings, that is some combination of sentiment and actual news, that reaction, even to the news part, is sometimes just a short-term concern, right? So stock sells off 20% because guidance for the next quarter is really weak. And that's a legitimate thing. Like you don't want guidance for the next quarter to be really weak. But what's it going to be like in 8 quarters?
Right.
or 16 quarters.
Yeah.
But the market's not reacting to that. That's,
Right.
People getting out because they have to make their year-end target or whatever the thing is. So,
And if I'm looking at a business, if I own a stock, I'm thinking maybe not 80 quarters, but certainly 30 or maybe 40 quarters out, right? Like 8 to 10 years away.
Yeah,
kind of thing.
exactly. Yeah.
But also because I'm thinking that far out, getting back to that, what are my tools to succeed? What are not my tools? I know that velocity is not one of the things that acting quickly, that's not something that I'm going to create alpha with, right? In a world of high-speed trading and accelerated computing, why even try to compete against quants, right? To get in and out faster than the news. We can't do it.
Right. And that was a learning I had to, realize myself, like going back to your question about like what maybe I used to do when I was new to this, I felt very compelled to react to news, even if it didn't, like sometimes I used to think stocks down, I would do my thing, or I just said I would go look and didn't look that bad to me. And then I would be like, I have to buy, they're missing this. And then were there times when had I been that quick to move, I would have benefited? Sure. Right. Sometimes then things do come back pretty quickly. But a lot of times, if you go back and look, you had a couple weeks, sometimes months, sometimes longer than that to actually, buy more. You have time to digest in most situations. Like I'll give you a quick example. When CrowdStrike dropped in the summer of 24 after that outage that they had, you had until into 2025 before the stock recovered back to where it was before that outage. You didn't know that at the time, but it came back. It is much higher than it was before that happened now, almost a year and a half later. But 2020 me would have been compelled to try to buy immediately. And 2024 me waited a little bit and did add to my position, but nothing crazy, didn't back up the truck. That's one example. And then like a more recent one, because we've talked about this one a lot too, the trade desk, which has not come anywhere near to where it was. And I don't know when and if it will, right?
Yeah,
I actually did buy that dip pretty quickly and then it dipped even more, right? So the times I have tried to act quickly, it even now, like as I'm a quote unquote more experienced investor, doesn't always work out.
Yeah, I think that's right. And again, it gets back to, what are we trying to accomplish? If I'm thinking about a business that I want to own, 5, 10, 15, 20 years, if I'm fortunate and everything's gone exceedingly well, making sure that I'm acting on the right information so that I can buy with the right level of conviction, right, is so much more important than moving quickly. And I want to give a couple of examples of thinking about the idea of incentives. So I want to go back to 2010. So 2010, I was still working a full-time sales gig, making money, DIY investing on the side. I hadn't even started writing for the Motley Fool at that point. So this is essentially where you were in like 2021. I guess is like a good timing way to think about it. And we went on a 17-day trip to Europe. I've talked about this before. 17-day trip to Europe. Me and my wife and my cousin and his now wife at the time was his girlfriend. He actually proposed to her there. And we were going through some of the most beautiful, historical, culturally enriching places in the world for over 2 weeks. And I would make a point multiple times a day to try to get somewhere that had internet. And in 2010, I mean, this was like the Stone Age in terms of like, there weren't great mobile apps. The iPhone hadn't been around that long. So you didn't have these, you weren't trading on your phone, right? It wasn't easy and slick and all that.
You didn't have
an
international plan with unlimited data.
I mean, I think we actually bought prepaid mobile phones. We bought 2 of them. So each couple had one with like, I don't know, 30 minutes of time for 2 weeks. Like if we needed to talk to each other, we could, and we had like a bunch of texts or whatever. But the point is like, it was onerous and inconvenient for everybody for me to try to do the thing that I wanted to do. And within like 3 or 4 days, my wife was like, look, there's 1 or 2 ways this can go. And the funny thing about it was I let it go, and we'd get back to the hotel at night and I would check the portfolio and all that kind of stuff. But I figured out after a few days, I'm like, I'm killing myself for no reason, like absolutely no reason to be doing this. So fast forward to 2012, 2013, I'd started writing for The Fool and was writing more and more. And it was making that transition from it being a side gig to my full-time gig. And the incentives switched. And I think this is an important thing to think about as an individual investor and a stock picker. because there's our goals. And we did an episode about this, goals versus incentives. I encourage people, if you don't remember it or if you haven't listened to it, go back and find that on your podcast app and check it out. And the point is that sometimes your incentives can run counter to what your financial goals are. Just as an easy example that I use there is, maybe you've just convinced your spouse in the past couple of years to let you start DIYing like rollover retirement accounts and all that kind of stuff. And you've made some bad decisions, or the market's gone down or whatever, and your spouse is super risk averse and the results are not good. Your incentives very, very quickly are to fix it, do it before your spouse notices.
Mm-hmm.
Often that leads to more stupid decisions and more losses, right?
It's like when you lose a lot at gambling, so you decide to just gamble more to try to win it back.
Yes, exactly. Right. It's the same exact mentality. So sometimes the incentives can get out of whack. And for people that are financial writers, for example, the feedback that we get from the market is number of people that read our articles, whatever incentives the outlet that you're writing for has, converting new members or signups for, Bloomberg might do something like they want people to sign up for newsletters or whatever. It's like whatever that structure is, you get perverse feedback that often has absolutely nothing to do with either the quality of your writing or the quality of the stocks that you're writing about. And it can make you fall in love with bad businesses just because readers responded to it. I think it's a cautionary tale for people out there to understand whenever you're consuming information, what are your incentives and what are the incentives of the people that are producing that information before you act on it. I think that's super duper important. And for media outlets, the incentive is there's voracious interest in consuming this stuff as soon after a company reports. And like the tail of demand just craters, right? It absolutely craters. So being first to market is more important than being best to market.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks Podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks Podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
Right. Yeah, the incentive structure is completely different. All right, so we've talked a lot already in this episode about what we both used to do, the way we used to think about this, and some of the mistakes we've made either in mindset or actual trading that resulted from that. So let's pivot to what we actually do now, because I'm a very systematic person by nature, and I'll talk about how absolutely nerdy I am when it comes to this in between earnings season time. But I know you are not that way. You are, as I affectionately refer to you, our resident raccoon on meth. So I would imagine you have a much more scattershot way of actually making your way through the stocks you own to kind of check in on them. So let's walk through. It is sometime in November or December, right? You don't have nothing you have to write or read about for work. You truly just have time to think about your portfolio.
Yeah.
It's in between earnings season. What do you do to make sure that you are up to date on at least, if not all, the most important stocks in your portfolio?
So there was something important you said there, and that's if not all. And I will tell you that I have stocks that I own that I don't routinely look at their quarterly reports more than just a like a cursory glance at the headline numbers. And that's all I do.
Mhm.
Like I don't do anything else. I'm far more likely to read annual reports. So sometimes I will be looking at a company like Rexford Industrial Real Estate, for example, or ticker REXR. It's a smallish holding for me. It's a business that I really, really like. It hasn't done super well lately because of all the tariff stuff. Like they own warehouses and light manufacturing real estate in Southern California. All the tariff stuff has just really been a chilling on that industry. So like, I know the macro stuff's not great there. So I haven't really like killed myself to really dig in too much to the business, but that's one that I'm actually going to read their last annual report from 9 months ago. And then I'm going to look at their quarterly report because I want to start saying, okay, what's the trajectory of business been over the past 9 months? And what are there some signals there that I can glean to look for anything that it might be time? Because again, it's a smallish holding for me, and maybe it's time to buy. Maybe it's time to add a little bit to a Rexford. I think it's an interesting company that I like a lot. And as we come through some of this tariff stuff, the stock could start ripping. And if I want to build out a position, I want to be mindful about doing it when the price makes sense. And I think valuation for something like Rexford really matters. So I will literally sit down in front of I'll have Fidelity open, and I've got it set up so that my accounts, my wife's Fidelity accounts that I also manage, it's all one screen. I will just start at the top and I will go through stock by stock, and I will look at the stock and I will think about it. And then I will decide, is it time for me to start doing a little bit more research? I mean, it's that simple. It is that simple. And every once in a while, I'll be surprised. I'll see a stock that was a very small holding. Then it's like, wow, this was a 1% holding and now it's 1.7, 1.8%. It's like, what's going on here? Have I missed some opportunity to add? Is this a business that I want to continue to own? Is it time to move on? I mean, it's just an organic process like that. It is just as mundane as I just described it.
That's actually more structured than I thought it was. I give you credit.
Well, and don't give me too much credit. It's easy to do it this way.
I know. The fact that you even like went systematically through it from top to bottom amazes me. Like
the system is like,
let me just tell everyone, here's how I imagined you actually did it. Like you're walking around your house, not actually doing any work, and
thinking time.
What you and I affectionately refer to as your thinking time. And then like you randomly think about Rexford, and then you, for no reason, not precipitated or caused by anything, you just read about Rexford for the next like 7 hours and then make a decision. And then you just move along your day until the next random thought crosses your mind.
I'm not going to say that happens, but I'm not going to not say that happens.
I mean, look, to some degree, I think that happens to everybody, but
I think so. But honestly, one thing that does happen is I engage in conversations with a lot of people that I know that's in investing. And Jeff, before you and I got to be friends, that's something that you really didn't have at all. And then, you and I connected, and some other people that we both know kind of built that little community. And I think that's one thing, like a lot of people that have signed up for our Patreon that have gotten involved with the $5 a month starter plan, and then have joined the Discord, are looking to try to build a little bit of a community to kind of have some conversations about those sorts of things. Because sometimes that's a big catalyst for me. I was, Tyler Crow and I were texting about, I was Canadian Solar, which is a bit of a misnomer because it's all Chinese manufacturing, but they do a lot of like development of big utility scale solar projects. They'll develop the project and then they'll sell it to a utility. And the stock is traded for like a massive discount to book value for a long time. And it just kind of bubbled up, and I'm like, is it time to sell this? And I texted Tyler and I said, I'm really thinking about selling and moving on here. And Tyler and I had a good discussion. There was like 4 back and forths. It was 200 total words. And then I spent 2 hours doing some research, and I'm like, I should probably buy more. of this business. And the funny thing, and a lot of it's timing, the stock's up like 45% since he and I had that back and forth. And there were catalysts that he pointed out that directly led to it. Having people to bounce ideas off of is very, very helpful. As much as anything I think it helps us reality check ourselves, because man, our brains get so echoey chamber and will lie to us about things. And we make decisions on vibes without anything to really back it up, besides our own biases. And having people that will push back is really, really valuable.
Yeah, I don't want to spend time on this, but one of the most helpful things for me is to reach out to people that I know that are investors, whether it's you or my real friends, and say things like,
real friends.
I'm thinking of selling this stock, or I'm going to sell this stock, or I'm absolutely going to cut my portfolio in half and sell half the positions, just to start that conversation about. And you're right, sometimes I end up going, no, maybe I should add more rather than sell. All right, so it will surprise no one that I have a spreadsheet that helps me keep track of the companies that I own. So I have a column for my like a column that tells me that I need to update my spreadsheet with the earnings. I have a column about the transcript or earnings call, and I have a column for the SEC filing. And I just check them off when I do them, because between what I own and what I track and follow professionally, I will forget, like, oh, I haven't listened to the transcript for this particular company in like 3 quarters, right? Like I only looked at the numbers and I didn't dig in. So I don't go through it like I must do it in this order, or I don't go and hit every single one every quarter, but it does help me make sure I'm not missing any for several quarters in a row. Because what will happen to me is, like, the ones that report early and late, I always get to, because there's less of them and I have more time. And then like all the ones in the middle that happen, like that one Tuesday, Wednesday, and Thursday where everything reports. Like for me this time around, it was the 3rd, 4th, and 5th, or 5th, 6th, and 7th, like that couple days. I have to make sure I get back in there, because there's so many at once, I'll just miss them. I always do the spreadsheet of the data because that's easy, but like I try to make sure I read the transcript and read the 10Q or 10K for as many companies as I can in this in-between quiet time. And when I say read, because 10Qs and 10Ks can be intimidating because they can be hundreds of pages long, I'm not reading most of the boilerplate legalese stuff, right? I'm reading, if it's a 10Q, I'm reading the management's discussion and analysis, whatever it's called.
Right, the financial results, yeah.
Yeah, I'm just reading like what they say about it. There's usually a short reminder of like, here's what the company does and here's how we make money. And that the depth to which they do that on the quarterly reports depends on the company. And then I either read or listen to the transcript for the earnings call. But I don't even, sometimes I kind of skim through that. Like the whole CFO thing where he just reads the same numbers that were in the spread, my like, here's what the earnings was, here's what the revenue was. Like, I don't need to read that again. I saw it on my spreadsheet. I'm more interested in like what they're saying about the business. I like to listen to what questions get asked and answered. So I use this quieter time to just try to like read as much as I can. And for me, I'm still in like the reps help me stage.
Yeah.
Right.
Yeah.
Like I might read the 10Q section about what the business does for a business I already know what the business does, but I still like to refresh it. I still like to read through it, even if I'm kind of skimming, going quick, just to kind of like get it in my brain even deeper. So here's my question to you. When are you most likely to make a sell or buy decision? Is it completely random, or is it during this quieter time? Is it during the deluge of earnings season? Does that ever impact you buying or selling? Like, did you ever say to yourself, I want to buy this or sell this, but I'm going to wait because they're about to report, or they just reported and I haven't had time? Do you time your buys and sells based on where we are in the earnings cycle at all?
If we're in between, but we're starting to sneak up on earnings season, I will look, and it depends on the company, but if it's a company that's been really volatile and there's a lot of stuff going on with their results and the industry that they're in, and the stock has a tendency to move a lot around earnings, and it's going to report like within a week or so, often I will either, let's say I'm going to invest $1,000 in that stock. I might wait, or I might invest 500 right then and then wait through earnings and then make a decision from there, whether I'm going to invest that extra 500 or not. And a lot of times what I will do is I will commit, like I'll make like a promise to myself, where if it's a business that I have a lot of conviction in, even if the stock goes up after earnings, but I'm happy with the results and I'm happy with guidance and what management is saying, unless the stock goes up like 45% or something that's not really rational or reasonable based on the valuation and the prospects, I will make a promise to myself that I'm still going to go ahead and buy the rest of the position.
Right.
Right.
Don't let a 5% pop scare you out of it.
Exactly.
Yeah.
Because that 5%, because so much of my portfolio is built on businesses that I'm looking for compounders, very, very substantial returns over the long term. Paying 5% more for the stock, if everything goes well, it's going to be irrelevant, right?
Right.
Now, if you're talking about like a Walmart or one of these blue chip stocks, paying 5 to 10% more can really materially affect your returns over the long term because of dividends and the low rate of growth and, that kind of stuff. I can get a little more disciplined with some of those stocks, but generally I do try to like buy, I wouldn't say within a few weeks after earnings most of the time, but still, a couple months before we get into earnings season for that back to earnings for that particular company.
Go
ahead.
No, I was gonna say, I don't think I wouldn't say when earnings will often keep me or entice me to make a decision, but it's certainly something I factor into whether or not, like if I'm sitting down to buy and like I'm between two companies and one's going to report like that afternoon, I'll just wait. Like, because the one thing, how we talk a lot about how the feeling of regret is so much worse than like the feeling of adulation, right? In terms of like human psychology. I used to try to be the guy who's like, I'm going to buy the day of earnings because it's going to pop. And then if it didn't, I would just be so mad at myself. Like, you idiot, you were wrong again. You could have just waited. But it also depends on the company. Like, there are companies where like, I've been thinking for weeks, I want to add to this position. And for whatever reason, I just haven't. And then sometimes it's like, this is the day, I got the money, I have the time to think about it. And I just do, even though they're going to report soon. Like sometimes I will but it's something I've given a lot of thought to.
Yeah.
I don't make snap decisions if it's during earnings season. So I would say I'm more likely to buy in this quieter time, but it also has a lot to do, and this is just a me thing, like how busy am I during the workday where I can even devote time to logging into my brokerage account? Like the time I have to do and think is after 4 p.m. and before 9:30 a.m. So I often will, go weeks. Like I'm in one of those cycles right now. I think it's been maybe more than a month since I bought anything or sold anything, just because I am not available during the trading day lately. But yeah, I think I lean towards waiting for the quieter time, just so I'm not making a decision. Like, cause like I said, my short attention span comes into handy this time of the cycle because I can forget what the market even did. And I can just make a decision based on what I'm seeing in the report and the earnings call and things like that. All right. So as we wrap things up here, Jason, here's the last question. Is there anything about your process in terms of catching up on your companies after earnings, in between earnings, that you think you want to change or tweak or improve on? Because I have one specifically that I've been wanting to do for a long time and I just haven't done it. So I'm just curious if you ever think, this is something I could do better.
So I think I've developed a process that works pretty well for me. And just to briefly describe what I've put in place is, number one, I'm pretty hardcore about waiting multiple trading days before I act on a decision that I reached, whether it's to buy a stock or sell a stock. To force that time in there, because it's just so easy. Things are so frictionless nowadays. So forcing that time in there to revisit the decision and to sit with the decision, I think has become extremely helpful for me to just make better decisions. I mean, there's been times where I'm like, I'm going to sell that stock. I'm just kind of tired of owning it. And it's like Monday and it's like, okay, I'm going to do it on Wednesday. And then I forget, right? Like, it's like, I had no conviction here. No conviction whatsoever. So that's one thing that I've done. But one of the things I've also done is I have required myself to go back and to look at the most recent financial results before I act, whether buying or selling, because it's so easy, especially selling, to do it just because the line on the screen went down, right? And not really focus on the trajectory of the business. So going back and looking at those results, and again, sitting with those results and really thinking about, well, what was my expectation? Is the business delivering on it? And then making the right decision, I think, is really useful. And lastly, it's because I do have exposure to stocks in so many industries, is making sure that I fully have the context of the opportunity and the risk of that industry before I act. Because there's so much more opportunity in a global economy today for some of these businesses, and the risks can come out of nowhere if you don't take the time to really just try to contextualize that. So spending more time looking at competitors and peers and what they're doing and what they're saying is something that I've done a lot more of than I used to do.
Yeah, that makes sense. For me, it's about, I always think I should be more of a journaler or a note taker, and I never ever do it. And I think it's for a couple of reasons. I just think that's not my nature. You and I both have a podcast called Investing Unscripted because we tend
There's a reason, people.
There's a reason. And despite my love for spreadsheets and organization, I'm a way more of a off the cuff person in a lot of ways. And I do think I journal to an extent, like the spreadsheets where I just plug the information in each quarter, like earnings and revenue and all the KPIs I track, I think is my version of journaling to some degree. Like even though I'm just transposing what you can get on a platform like Fiscal AI, by the way, sponsor of ours, use our code. The act of me typing it in separately, I think is a little bit of me remembering what's going on and journaling. But I kind of wish I had a little template that I used for each quarter, where it's like 5 questions that I make myself answer in narrative form or bullet points with words that I just kind of force myself to do every quarter. All right, so whatever, I'll just pick a random company. Airbnb has reported, answer these 5 questions about the quarter, and then file it away. Because I do wonder if that would be helpful for me. Actually, I'm glad I brought up Airbnb because I've been on the fence between sell it or add more to it for a while now.
Yeah.
And it would be interesting to go back and read what I was thinking after the last 2 times they reported versus like now after they just reported a few weeks ago. I just can't find the right like template to do that with. And then the other thing is, do I realistically have the time to keep up with that?
Yeah.
Right. I barely have the time to do with the things I'm doing now. But if I had to pick something, like it would be that. So if anyone's listening and has like a really good template for this, send it my way. I'd be happy to see what you're doing, but that's what I would change.
So 2 quick things. One, I think the process of taking those KPIs and manually putting them in your spreadsheet is a reinforcing behavior. And I think even though it doesn't directly do what you're talking about, where you're having a dialogue with yourself almost, you're putting the numbers over and having read the results, you're planting seeds in your brain that are going to reinforce those things that you read then when you pull the KPIs over. So I think they're not mutually exclusive. And I think what you're doing is a step in the same direction that probably works pretty well. But tools like Fiscal AI, I think are great and useful too. So look in the show notes to use our code to subscribe. Our good friend Sina is a wonderful, incredible human being. Sina subscribed to Fiscal AI. Sina did not use our code.
Yeah.
Don't be Sina.
No, I think what you should have said was former friend Sina.
No, he's still our friend. He just owes us a lot of drinks.
Yeah. Oh, he's still okay. I was going to cut him out, but that's fine.
No, we'll keep him. He's a keeper.
We'll keep him.
Yeah, he's a keeper. Yeah.
All right. So we'll let that sin pass by.
All right, let's wrap this up. Just a couple things.
We got to run here, so let's finish this.
Yeah, just a couple things I want to just kind of reemphasize again. Having a process is so important. Be aware of your incentives and how they can lead you down like the wrong decisions, especially in earnings season where there's so much heat and light and noise already that's incentivizing doing stuff, where your mantra that you picked up a few years ago, right? Don't trade, learn, learn more, trade less is so true, but also the incentives of the people who are producing the info and the outlets that are producing the information that you're consuming is so important to making better decisions. And sometimes the best thing to do is just get the hell away from earnings season when you can sit with things longer with less noise and other people telling you what they think.
And I just want to, my way of wrapping this up will be to piggyback on something you said a few minutes ago, because it's actually something I do a lot and I didn't think to mention it myself, which is when I am making a decision or having a thought about a company, whether it's to buy or sell, I will go back and look at the last quarter results and maybe the last couple quarters results, because with time, I sometimes see things I didn't see earlier.
Yeah.
My recollection of my sentiment about the last earnings report will be negative, and I'll go back and look and be like, actually, there's some green shoots here that I was missing, or vice versa, right? Maybe I was bullish and I look back and I'm like, you know what? This has been languishing for a really long time. Will it ever recover? It's only with that time passing and going back and looking at actual data and not vibes that I can sometimes get a more clear answer.
The wonderful landscape photographer Ansel Adams said when asked, what's the best camera to use? It's the one that you have. A system that works for you is more important than somebody else's system that's perfect for them. That's the key there. So
yeah.
All right, Jeff, you ready to wrap this up?
Wrap it up.
All right, everybody. We love giving our insights, sharing our thoughts on how to navigate post-earnings season effectively to make the most of all this information we have to make the best investment decisions. But our answers are still our answers, as awesome as they may be. You need to make sure you have the right answers for yourself. You can do it. I believe in you. All right, Jeff. We'll see you next time.
See you next time.